A lot of people think tax accountants are the busiest time in March, April, but it's actually right now. Virtually every planning opportunity that's presented goes away December 31st with the strike of midnight. And so right now is the time that we're knee-deep in planning, thinking, coming up with opportunities, seeing where the pitfalls are, where the gaps are, where the opportunities present. So I wanted to just punch list some things. Maybe they'll tickle a memory for you or an idea to come up with. Maybe they won't. But I'd like to challenge everyone in this room, and I'm going to ask at the end, if I gave everyone in this room some idea, some nibble, some concept that they can either go home to their own tax professional or go online and look into. But tax projections are critical. Gives you a good idea as to what's due now, i.e. December, what's due March, what's due April, what's due with pensions in September. Tax projection, a formal tax projection is what you should be asking for. It's a one-page summary of a 1040 and everything that flows into it. There'll be a lot of assumptions, a lot of round numbers, but everybody in this room should have some sort of tax projection being prepared for them, for guidance. Tax loss harvesting. This year in the market, this is the greatest year of dispersion that we've seen in a very long time. So in most portfolios, there are some losers. Now is a good opportunity to harvest those losers. You sell the losers and you can take those losses and replace them with similarly, economically similar positions and pocket the tax credit or deduction or loss that's created. So tax loss harvesting is critical. The corollary to tax loss harvesting is charitable giving. So if you've got a position that's done really well recently, think NVIDIA. I don't know that NVIDIA is going to be the greatest next thing in the next 1, 2, 3, 5 years. I just don't know. If you have an NVIDIA position, now's the time to think about charitable gifting. You can do that directly to institutions by transferring the shares themselves or through a donor-advised fund. Roth conversions. For our folks, our 4 rocks who are out to pasture, this year, if it was a quiet year economically, think about a Roth conversion. You'll take advantage of some low brackets. You'll offset future RMDs, required minimum distributions, because the Roth accounts have no RMDs. So if you can cut down on your taxable pension accounts and convert them to Roths in low bracket years, which some people in the room have, because your peers are also excellent at their trade. No one can tell who is the older folks in the room. But there are some people in the room who that might apply to. 529s are a great thing for kids or grandkids. And they've gotten better recently. Because 529s, which are accounts for college savings, so the way it works is you can put money in and it grows forever tax-free, provided the funds are used for education. You can do 5 years at once, and you and your spouse can each do that. So if you do the math, you could do 10 times 17, 170 grand into each child's 529 account. And if you do that for a youngster, you can pretty much tick the box on their college education. So if you were to put $170,000 into a newborn's 529, that'll double about 3 times, or that'll double twice before the kid's ready to go to school, and you've pretty much paid for college based on reasonable assumptions. But I actually funded a 529 for myself this year. And if anyone saw my bio, I've got no interest in going back to school. None at all. I've got my master's degree. I've got my higher education. I loved school, but I'm done. I still funded a 529 because I put $10,000 into my 529, and I will be able to convert that to a Roth. So what I really did was put $10,000 into a Roth IRA. I did it in 2 steps, $10,000 into my 529 now. I will then later on convert it to a Roth, and that whole process will be tax-free. So my 10 grand will come out at age 70 or 80, please God, even later. All that growth will be completely tax-free. If you do that for you, you do that for spouse. Nice way to get 20 grand into your 529 or into your Roth, really. Annual gifting, also a really nice thing to do. You can give, it's sort of related, you can give to people who might be dependent on you or to kids if you have a taxable estate. Anything above your exemption amount will be subject to about 40% estate tax. We can talk about that a little later. But that's a moving number. The exemption amount right now is as high as about 13 million, but that's going to come down to about 5 million. So if anyone in the room is going to die with either more than 5 million, or if you're married more than 10 million, Annual giving is something you should be thinking about. And then fractional gifting is also kind of a neat thing. Again, for the same type of person who's going to die with more than 5 million per person, 10 million per couple, you want to start giving away things. And if you give fractions, you can do it more effectively. And just the value of half is worth less than 50% of the whole. And that's kind of a tricky kind of thing. Other things that I'm seeing that are just I'm seeing on my desk. I'm doing projections all day, every day now. I'm seeing people put their kids on payroll. I don't want you to put your 6-month-old on payroll. That's ridiculous. But if you've got a child, particularly who's on your website, as graphics, or comes in on Sundays to help you in the office, I got my Charlie here for a good reason. You now know why. If you can pay your child, that income is tax-free to your child, tax-deductible to you, and you can fund their Roth. So it's sort of a three-way kind of thing. It works well. If anyone in their family is supporting someone else in the family, think about taking them as a dependent. I just had a case now where a very wealthy client of mine is supporting his troubled sibling. His troubled sibling has all kinds of medical expenses. My wealthy client is paying for everything. My wealthy client is actually taking his sibling as a dependent, and all of the expenses become deductible to him. So it's pretty clever. Think about that. If you've got older parents or siblings, and that's neat. Just last thing on the slide is IRAs directly to charity, which is a neat thing to do. Normally, people take their required minimum distributions, which begin at age 72, as taxable income to themselves. And then separate paragraph, they then write checks to their alma mater or their church or their synagogue. But you can actually go directly from the IRA to the charity and avoid the taxable income, which is a nice strategy. By a show of hands, I don't want to go the negative. Has everyone learned something that they might apply to them? Okay, I think I'm doing pretty well here. Okay. You're going to blow away your financial advisor when you call them up with your MD and your successful practice and you say, I want to fund a 529 for myself. They'll be like, what? And you'll explain, and they'll be enlightened. Financial housekeeping, also something we do as part of our tax prep. If you are getting a 1099 or a property tax statement and it's addressed to you personally, then some housekeeping has to be done. Everything should be in the name of a living trust. Who needs a living trust? Everyone needs a living trust. A lot of my single clients say, I don't need a living trust. They need a living trust more than my married clients. If you are married, I'm married. If, God forbid, I showed up in the back of an ambulance at Cedars, God forbid, my wife would have absolute control of our financial affairs. She could access my accounts. She could pay our bills. She could make my medical decisions. She would be entitled to access to my hospital room. No problem. But my single client who shows up at Cedars is in trouble. No one can write a check on their account. No one can make their medical decisions for them automatically without court intervention or complex document that you're all familiar with more than me. But I just urge everyone in this room to have a current estate plan and to fund it. And now is a good time because January you're going to get all your 1099s. It's a good thing to look through and make sure that all of them are addressed to your trust. Nothing should be addressed to you. Virtually nothing. Some things are practically difficult to put into a trust, like a car, but generally speaking, that would be a good rule of thumb. Umbrella insurance. I joke with my dad sometimes. We should write a book. I have a client of mine who has a Los Angeles sidewalk in front of his Los Angeles house, and a California neighbor tripped on a gap in the sidewalk yay big. $2 million lawsuit. $2 million lawsuit because some clumsy guy tripped on his sidewalk, which had a slight gap in it. Who among us doesn't have a slight gap in their sidewalk in front of their home? So I used to say $1 million umbrella was appropriate. Now I'm saying 5 or whatever the carrier will issue. And it's very, very inexpensive coverage relative. I think my $5 million umbrella is like $1,600 a year. If you think about coverage relative to premium, it's cheap. It's cheap. And as you accumulate your wealth, we look to Munger, who died this past week, who was a great mentor to us in our thinking. It's really about avoiding mistakes and safeguarding your wealth and being patient. I mean, he had 100 years to be patient. I don't know that we all will or want 100 years to be patient. But uninsured exposure is just something that is so easy to deal with. All of us here are paying 13.3% income tax to the state of California on our earned income. You do not need to pay that on your investment income. You do not need to leave California for your assets to leave California, which is a pretty slick thing. You can establish trusts outside of California, complete a gift, nominate an out-of-state trustee, and avoid 13% on that income. So depending on the circumstance, this might be really good. Something also our New Yorkers like. Our New England states tend to be really good tax-friendly jurisdictions to set up trusts. If the assets and the beneficiaries are not in those states and it's just the trustee, then you generally, and the states are slightly different laws, but New York, New Jersey, Connecticut, you can escape those state tax there and state tax here if set up correctly. And a lot of my clients have family back east, and it's a really convenient solution. So the big hesitation with out-of-state trusts is, who am I going to trust? You start paying for professional fiduciaries, you're worried about control, but if you have an old college roommate or a family member that lives in New York, it's a very good strategy. The law did change last year. You actually need to complete the gift. It used to be you could avoid the completion of the gift, which is a little bit technical, but it's absolutely still compliant to do that in the certain circumstances. Life insurance should be held in an irrevocable life insurance trust. That's a big deal. Particularly our young docs who are buying term insurance to protect their income in the event of a premature death, which is really well solved through term life insurance. It should be held through an irrevocable life insurance trust. It effectively doubles the death benefit, is a good way to think about it. And that document will probably cost you about $1,500 one time to set up. I hate to quote other people's fees, but that's a good range. So just a thought on that. And that's it. I'm going to... Any questions? I know I flew through that. I didn't want to make this boring. I wanted to make this quick and rapid fire. Year-end tax planning tips. That really, yeah. My question,
John, you've worked with a lot of doctors. Mm-hmm. You've had a lot of doctor clients. What do you think is the biggest mistake us physicians make when it comes to
one more slide here? No.
And don't say C.B. Spencer.
Divorce. That ends up being pretty costly. Divide by 2 a couple times and it becomes pretty painful.
The lines laugh a little too hard.
Yeah. I really think that, going back to Munger, I think it's swinging for the fences. I really think we need to be looking at this as navigating a cruise ship instead of a speedboat. And you need to think about a long-term strategy and stick with the discipline. All too often, my docs come to me with, palm oil farm in Belize, 75% IRR. What do you think? I mean, and no one in this room has come to me with that. John, you've not come to me with that. But these get-rich-quick schemes, it's not the way to do it. It's never going to work. I mean, it will work. Just as a lottery ticket will work. It works often enough that it's tempting. That's the problem. But I really think that the slow and steady, let me focus on my practice. Let me fund my pension diligently annually. Let me be prudent about my expenses. Let me be strategic about deducting my business expenses to the maximum extent possible. And that's it. I think that's the secret. I really think that's the secret. I hope that answered the question.